Lately, I've been hearing this a lot. Alberta multifamily investments are slowing down, vacancy is ticking up, rents have flattened in some pockets. Is the opportunity over? And on the surface, I get why people are asking. But here's the part most headlines completely miss. Alberta's multifamily market did slow in the short term. However, the underlying demand never weakened. This is not a collapse. This is what a healthy market normalization actually looks like. If you're new here, welcome. And if you've been following along every Thursday, I really appreciate you being here because I know a lot of you are trying to answer the same question right now. Is Alberta still the move in 2026 or did the window close? Stick with me for the next few minutes. I'm going to show you what's actually slowing down, what isn't, and why the difference matters more than ever. Let's start with what's real. Coming out of 2024 and into 2025, Alberta saw aggressive rental construction, fast lease-ups, strong rent growth, and relatively cheap capital. By 2026, a lot of that supply started hitting the market at the same time. Developers responded the only way they could, by slowing launches and underwriting more conservatively, especially in Calgary and Edmonton. That's not panic, that's discipline coming back into the system. Now here's the part that actually matters. In 2025, Alberta led Canada in net interprovincial migration. The provincial population surpassed 5 million, and the majority of new arrivals were young, working-age households. That data matters because people drive rental demand, not sentiment. So even while the market cooled, the people didn't stop coming. The slowdown wasn't caused by demand disappearing. It was caused by supply briefly catching up. This is where investors need to think clearly. Young mobile workers tend to rent longer, value flexibility, cluster around employment nodes, and disproportionately support multifamily housing. So what we're seeing now isn't demand falling off. It's demand becoming more selective. Well-located, properly structured multifamily projects continue to perform. Marginal deals that relied on aggressive rent growth assumptions struggled. That's the difference. And this shift matters even more heading into 2026. Capital is more selective, underwriting is tighter, and only quality CMHC eligible multifamily projects are moving forward. You can't rely on optimistic assumptions anymore. You have to underwrite conservatively. You have to structure properly. And the deal has to work on today's numbers, not tomorrow's hope. This isn't an exit phase, it's a filtering phase. So if you're waiting for Alberta to heat up again, you might be missing the point. Balanced markets are where long-term investors win. The market slowed, the people didn't. And this is exactly why some CMHC-eligible multifamily projects in Alberta still work and why others don't. Next week, I'm going to break down why CMHC MLI Select is still the best mortgage program in Canada, but also why it's no longer forgiving, and why where you buy and what you buy matters more than ever. See you next week.